We'll begin with a brief context setting presentation from Big Mint by Darshna Vyas, a market analyst at Big Mint, bringing over 4 years of focused experience in India's metal markets. She began her professional journey with ferrous scrap coverage and subsequently played an instrumental role in building Big Mint's non-ferrous vertical, contributing to analytical coverage across aluminum, copper, zinc, and lead. Her current research is centered on the copper market, where she closely tracks price movements, trade flows, and scrap market dynamics in an environment of tight supply. She leads Bigment's copper portfolio, providing structured data driven insights to traders, manufacturers, and downstream stakeholders across India's copper value chain. Over to you, Drishya.
So, good morning to all the panelists, industry colleagues, and participants. And thank you for giving me the opportunity to speak today. So, Dr. Copper dominated the commodity conversations in 2025, and it continues to stay in the spotlight as we enter into 2026. So, in 2025, the prices rose sharply and touched record highs, not because of the hype, but because there was not copper enough available. The stocks were low, the supply struggled to keep up, and the demand kept growing across the world. So, today I will briefly explain how we reached this point, why prices climbed so much, and what key things the market should watch as we go into 2026. So, before we move forward, let me give a small intro about Bigmint. So, Bigmint is an ISO audit price reporting, market intelligence, and consulting platform for global commodity markets. We are providing independent price assessment, data, and insights across ferrous, non-ferrous, scrap, energy, and logistics markets, helping industry participants to make informed decisions, procurement decisions, and strategy decisions in South Asia. So now to understand 2025 and how copper has historically been, we need to take a step back. So 7 to 8 years ago, India was a net exporter of refined copper. Smelters were running at healthy utilization rates and exports came naturally then. The turning point came in 2018, wherein the sudden closure of Vedanta's Tuticorin smelter, almost 4 lakh tons of refined copper vanished overnight, and that was a real shock to the industry. That single event flipped India from being a net exporter to a net importer. So between 2019 and 2022, the gap widened further. The mining auctions under the MMDR framework, that is Mines and Mineral Development Regulation, were intended, but copper mines take usually 5 to 7 years to deliver output. Meanwhile, the HCL's Indian copper complex also shut down in 2019. It further tightened the supply even more. And from 2021 onwards, the policy finally caught up with the reality in the union budget. The import duties on concentrate and scrap were first reduced from 5 to 2.5% and later removed completely, accepting that India must rely on imported feedstock as well. And today the story is clear for all of us. India has shifted from export-led refining to scrap and concentrate dependent model while exporting more value-added copper products. So let's have a quick look at 2025 numbers. In calendar year 2025, the domestic refined copper production improved more than 30% to about 0.73 million tons from a year earlier. So this improvement came from two factors. Firstly was the better smelter utilization rate. Second was the incremental volumes from Adani Kutch Copper in Mundra, which added roughly around 35,000 to 40,000 tons since July 2025. However, the key take point is this: supply is improving, but not fast enough. So that is why imports still play a balancing role. So if we move towards the cathode imports declined by 17% to around 0.22 million tons in 2025. This was not due to weaker demand. It was due to BIS, which was imposed on cathode imports. And to bridge this gap, producers increased imports of blister copper and scrap, supported by lower import duties. So, as a result, India's copper supply chain transformed from moving from heavy import dependence on cathode imports towards greater reliance on blister and scrap as a feedstock. So, coming to the secondary market scenario, this is where the market actually adjusted. So, copper scrap imports jumped nearly 40% to 440,000 tons in 2025 compared to the earlier year. So, it had two clear reasons. First was the 2.5% custom duty, which we just discussed, which was removed on the union budget. Second was the cathode availability, which tightened after the BIS norms were introduced. And a very important data point here to highlight is that the copper scrap exports from US to India, which had surged nearly 180% year on year, crossing 105,000 tons and this year. And this tells that scrap is no longer a backup source now, and it is now become central to the India's copper supply chain. So let us move to the most important part, that is how prices evolved in 2025. So 2025, as we all know, was a very defining year for copper. Copper prices touched $13,000 per ton, which was 42% higher, with a sharp Q for rally we can see in the graph. It surged to 21% quarter on quarter. And if we discuss why did this happen, there were some macro factors. Like first was the China, who spent aggressively on infrastructure before July 2025, while the USA has cut interest rate multiple times in 2025. This improved liquidity and also the investors' appetite for metals. And next is the supply stress, wherein more than 5 lakh tons of mined copper were lost due to disruptions. And TCRCs, that is treatment and refining charges, collapsed to near zero levels in late 2025. And third was the stock movements. Nearly 8 lakh 90,000 tons of copper moved to the USA ahead of the tariff risk that drained availability of copper elsewhere in the world. And about two-thirds of the visible global stocks are now held on COMEX. And also we can see in the graph that LME inventories nearly halved from about 2 lakh 80 to 3 lakh tons in mid 2025 to around 1 lakh 40,000 tons by December 2025. So let us discuss what happened in global copper market and what went wrong in the recent years. So here we can see the concentrate shortage, which is on the very high, and it is not new; it is cumulative. So over the last 2 years, the copper market has not just grown; it's been quietly tightening itself. So between 2024 and 2025, nearly 2 million tons of new smelter capacity came online, taking up more concentrate. And now in 2026, the pressure is turning into real stress. Another 1.4 million tons of smelter demand is hitting the market, but mine supply is not keeping pace, partly because of disruptions at major operations like Grasberg mine and a mine in DRC. And new mine additions this year are only expected at 7 lakh 30,000 tons. This is far short of what smelters need. So we can see the impact in the numbers. The International Copper Study Group had earlier expected a refined copper surplus of around 1 lakh 78,000 tons in 2025, but that's already been trimmed down from earlier forecast in April. And in 2026, ICSG now projects the market to swing to a deficit of around 1 lakh 50,000 tons of refined copper as the result of slower production growth and tight concentrate availability, constrained refined output, even though the demand is keeping, even though the demand is rising. So once we factor in this normal disruption rates by around 5 to 6%, the picture is becoming clearer. The market will face a concentrate deficit of around 6 lakh 50,000 to 8 lakh 50,000 tons in 2026. This is what the industry expects, and this is why TCRCs collapsed to zero and even turned negative in the last quarter of 2025. And this is also why refined copper remains tight with no easy relief in sight. So this slide shows us the Indian domestic and imported copper prices. As global prices started moving up, India prices moved with them as well. So here we can see domestic copper scrap prices closely followed the direction set by the LME, especially in the second half of the year, that is after July. What stood out was the speed of the response. Whenever global prices was moving up, the impact was felt quietly in the domestic market, with the effect becoming more clear in the final quarter, that is October to December. This shows a clear change in how domestic copper prices work today. So they are no longer decided only by local supply or demand. The global copper prices now play a direct role in the industry. So going ahead, the message is simple. The global copper prices continue to remain strong, and domestic prices will also stay high. The connection between both is strong, we can see as of now, and we are already seeing its impact. So let's take a look at what's ahead for copper in 2026 and why the market will stay interesting. So these are the most global trading houses which expect copper prices to stay near 12,000 per ton this year in 2026. And the reason, like how we discussed, the mines take time to expand, the concentrate availability is limited, and even small disruption can make prices move very noticeably. And for 2026, there are three main things we can keep an eye on. First is the TCRC, which are basically the charges earned for processing copper concentrate. And when TCRCs are low or falling, it means raw material is scarce and smelters are under pressure, which keeps copper supply tight. Second, the availability of the scrap, especially in home, that is India. Any shortage here can quickly push the domestic prices higher. And third is the disruptions in large global mines, how we have seen in 2025. So even a small problem at a major mine can shake the market. So this is not a market where prices easily fall. It's a market where staying alert and managing volatility will matter the most and work the most. So here are some points where which I will discuss what's new for the industry and its impact. So in 2025, a few important policy changes helped to ease the pressure in the copper market. So first was the government who withdraw the BIS quality control orders and softened the QCO norms for non-ferrous metals. So this reduced the delays at ports and made it somewhat easier for overseas suppliers to ship copper into India. And as a result, imports are expected to become smoother and little more predictable. Second was the GST rationalization for copper and copper alloy products, which improved the cost competitiveness or for downstream manufacturers. The lower tax rates will help cable makers or fabricators and alloy producers to manage their cost and better and stay competitive in the market. And third is the recent Adani's deal. The India's thirst for copper is growing and Adani is ready to meet it. So to power their new smelter in Gujarat, they have signed a long-term deal to get copper straight from a mine who is producing 62,000 to 70,000 tons a year. No middleman and no delays. The copper will flow directly to Adani's Mundra plant. It's like having a personal supply line from the mine to the factory. So we can look it just as a direct supply line to meet the rising demand of India. So these are some of the upcoming capacities. Several big companies are investing in copper in India, but their benefits will be seen slowly over time. So Adani's Kutch copper plant will help India make more copper at home. So going forward, we need to import less finished copper from other countries. However, India still has to import raw copper material like scrap and concentrate. So we are not fully self-sufficient yet. And JSW Group has entered copper mining through contracts in Jharkhand region, targeting its partial operations by financial year 27. Also, Hindalco industry is focusing on recycled and value-added products. So overall, these projects will help building a stronger and more organized copper industry in the India over time. But in the near term, copper supply will stay tight and prices will continue to follow the market trends. So to wrap up, India's copper story in 2025 was never about the running short. It was about adapting. So like how we saw, scrap became king, prices literally danced to the global tune, and the market showed how fast it can pivot. So as we step into 2026, the focus is not on relief. It's about handling ups and downs smartly and staying one step ahead of the market. So thank you all for the attention and I look forward for the discussion.